All right, y'all. Welcome back to Strat. Today we have Joe Rohne, who is a savvy agent and just in general, a short-term rental expert that has experience building a portfolio of his own. He's also gone through the cost segregation, bonus depreciation process, and just an overall wealth of knowledge. Joe, welcome. Thank you for being here today. If you don't mind giving everyone a quick introduction to who you are and what you do.
Yeah, thanks for having me. Glad to be here. I've been in the short-term rental business for about 4.5 years now. Bought my first property in 2022. Actually bought two back to back. Ended up a partnership on one, and my wife and I on the other one. Quickly jumped into co-hosting. Within the first 3 months, we had already picked up two co-hosting properties and started managing for others. And what I realized is there wasn't a lot of realtors in space in my market in Panama City Beach that understood short-term rentals and underwriting and all these different things. So I ended up getting dual licensed and licensed in Florida. And in 24, I joined the Savvy STR agent team, and we have been helping investors find great properties ever since.
Yeah, and Savvy is an incredible company and business. I see you got the skateboard right there behind you. Can you talk a little bit more about Savvy and who does Savvy typically help?
Yeah. So one of the things that we pride ourselves at Savvy is every single agent on the team is we don't just own short-term rentals, but we're active investors, right? So we're working alongside our clients that we're helping find because we're looking for those properties too. That doesn't mean we're taking the best deals. It means we're also investing in this space and we believe in it. And we believe in it because we're obviously highly successful at doing it. So no matter what market you're in, you're going to be working with an agent that is an investor themselves, co-host or manages themselves, owns themselves. So they truly understand the market because they're in it every single day, and they're not only doing it for their clients, they're doing it for themselves as well.
Awesome. And remind me, so your market and your territory, what does that look like? Where does it expand to?
So I handle everything in the Northwest Florida Panhandle, specifically Panama City Beach. I actually have my own like team within a team, and they kind of span out Forgotten Coast, 30A, Destin, Fort Walton. It's 140 miles of beach, so it's hard to have one person try to stretch all that and be an expert in everywhere. So we kind of have our own niches. So no matter what market you're interested in the Florida Panhandle, we have somebody that can help guide you in that spot.
Yeah. And a lot of people here might be looking for their first short-term rental or, maybe their next one, but typically they're still looking to figure out which market to invest in. Could you talk about your process for investing in a market? Maybe that's your own market, maybe it's how you look at other markets, but how would you guide someone on selecting a market and feeling confident going into that market?
So, we own in the Panama City Beach market, but we're looking to invest in a couple other markets ourselves this year. And the first thing that I look at is traffic drivers, right? I like traditional vacation rental markets. There a lot of people say, suburban and urban and all these other places you can find like secret niches. But the problem is in those situations is you don't know what the regulations are. And maybe they don't have regulations today, but they could have them next year with the new, congressman or the new mayor or whatever it may be. So I like investing that are there in places where short-term rentals are welcomed. There's already regulations in place because there's taxes being charged or there's permitting process, whatever it may be. It really helps eliminate that long-term risk that you buy something and then 2 years later someone says, we changed our mind. We don't want you to do this anymore. So I like traditional vacation rental markets. There are 13,000 vacation rental markets throughout the United States. They're all over the place. And every single state has a vacation rental market, and it can be in places like St. Louis. You just have to really understand what the regulations are and make sure that you're working with someone local that can help you guide through that.
Yeah, yeah, definitely having someone that's an expert in that market that understands, especially what you said, regulations, because that can change a lot. That's a hot topic right now. Which counties, which municipalities are going to allow short-term rentals? Which of them is there going to be a cap on the amount of permits and whatnot? So finding someone in that market that knows that municipality, that knows those regulations already is such a time saver. And then when it comes to seasonality, because I imagine that's a factor for you with more so a predominantly beach market. How do you look at seasonality in terms of the clients that you are walking through the process of picking beach market in general?
Yeah, I mean, every market's going to have a season. Everyone's going to have a
Mhm.
peak season, everyone's going to have a shoulder season, everyone's going to have a slow season. But no matter what market you choose, if you differentiate yourself and you become one of those top tier properties, the top 10%, top 5% of properties in your market, the seasonality doesn't matter because you're going to book year round. And, the market average in Panama City Beach, for instance, is 58%, but my short term rental was 74% occupancy last year, right? So, when people were empty in January, we did $6,000, but it all comes down to what you do with the property, right? This is not a turnkey business. This is not a business anymore that you can just, make your property look like the Golden Girls and think you're going to be successful. You got to invest in your properties and make them stand out and make them look like, what I like to call scroll stopping photos, right? If you're
Mhm.
scrolling through anything, what's making you stop and look in that property? And if your property doesn't have a scroll stopping photo, it's going to get passed by, and that 73% occupancy is going to be 43% occupancy. So the seasonality really comes down to the quality of property and understanding the avatar and the people that are coming into your space.
Yeah, and you mentioned something there that's a perfect segue, talking about making your property stand out or getting to that top 10 or top 5% of listings in your market. What are certain things that you are looking at before you get into a property and pull the trigger on a purchase to make sure that property can be the property that makes the top 10, top 5% list or stands out amongst all the other listings?
Obviously when you're analyzing data and you're saying, okay, what properties work? In my market, it could be anywhere from a 3 to 8 bedroom, but it doesn't have to be beachfront. That's one of the biggest misconceptions is, oh, you have to have a beach view to be successful. And my most successful properties are 2 to 3 blocks with no views. But what we're looking at is what can our design be? What can we do to the property to make it stand out? And that could be adding putting greens or turf with bricks and pergolas and of course pools and could be hot tubs or screened-in porches. All those things that create the experience is what's going to make it stand out. I like to share one of my a review that I got about 6 months ago. It's my favorite review that I've ever gotten, and it was a client that stayed at one of the properties that my wife and I designed and we co-host. And it said that the actual review basically said, we always come down to Panama City Beach. We've been coming here for 10 years and we always get a nice house. We go to the beach. Everyone comes back to the house. They go to their rooms, get on their phones. But at Joe's house, he created this backyard that everybody put away their electronics and we made the most amazing family memories that we've ever had. And we're going to be coming back every year now.
Yeah, that's beautiful, man. It's a whole nother side to this business that can be rewarding on top of all the financial and investment, benefits. It's a hospitality business. So you are hosting families and friends in some of their best memories. So that's a part of the business I love. And it's definitely a perk, but I know a lot of people coming through this program are focused on numbers and making sure they're getting into a profitable investment on top of having the appreciation potential and the tax benefits. So, how are you underwriting deals? Are you looking at to make sure they are cash flowing and to make sure you're okay purchasing it or guiding a client into being okay purchasing that?
Yeah. I mean, it's actually funny. At 6:30 tonight, I'm going to be teaching an MBA class at Webster University in St. Louis about underwriting short-term rentals. I have a 1 hour presentation that the professor is having me come in. So, what I'm looking for, the first thing you're looking for is obviously your market, right? Is it a market that's investable? And if you're looking at AirDNA or STRIQ, or STR Insights, doesn't matter where you are, there's different data platforms that are going to say, okay, this is a market that is very investable. And then from there, it's what type of property, right? It might be a 1 bedroom in this market, but a 4 bedroom in that market. And then from there, you're really diving deep when I'm underwriting. I'm looking for the top 5, top 10 properties, right? If I'm looking for a 4 bedroom property, show me the top 4, top 5, top 6, and what those revenue numbers are, because that means it's possible, right? If there's one outlier that's way up here and everybody else is here, this is probably where your numbers are going to be. But if there's 5 that are up here, all right, now we have 5 properties that are full-time short-term rentals. And I think the hardest part of analyzing data, and I talk to investors all the time, is they look at the average. Well, the average is only doing this, and there's all these other properties doing this. And I always ask the same question. Okay, are they full-time vacation rentals? Is the owner staying at half the year? Does it have a manager that's actually managing it well or just setting it and forgetting it? Do they have a good design? Do they have good amenities? Like there's so many factors when it comes to analyzing your short-term rental that you can't just say, this is the number I want to go to, because if you want to be successful in this business, you have to be in the top 10%. Period. There is no ifs, ands, or buts about it. And that's in any business in the world.
Yeah. And it also makes me think about how many people are in this space that do not belong in this space. So part of the commitment to going down this investment route is committing to be a professional operator and listing a property like a professional operator would. So getting the high quality photos, making sure you're doing the dynamic pricing and whatnot. So that's a great point. But going back to that same question, talking about like cash on cash returns, do you have a threshold or a metric that's your North Star? So it's 20% cash on cash, or how do you approach that?
Yeah, so I mean, the cash on cash return is going to really come down to underwriting. The first thing we're looking at is what's the yield, what's the gross ROI, right? And we're looking for 20%, right, from the get-go. So a
Mhm.
property that is $750,000, are there comps that are doing $150,000 in gross revenue, right? So that's like step number 1, right? So if I can't find, if it's $1 million property and the best comp I can find and it's is doing 125, that's not going to pencil out right now. That being said, that 750K property that's doing 150K, now we got to take it and put it on paper. Okay, now so we have our 150 in gross revenue. Now we got to add in our pro forma and do our expenses, insurance, taxes. There's some places like Texas, is really, really high in property taxes, where in Florida we're really low, but in Florida we have higher insurance costs than other places, right?
Right.
So it's not, you got to really underwrite the whole package. And then the next part is structuring the deal, right? So this is where your realtor is going to come in the most. I tell every investor, I'm not trying to get you the lowest priced. I'm trying to get you the lowest cash out of pocket, right?
Mm.
Because when you're less cash out of pocket, that's where your cash on cash return comes in. And I'll give a for instance, if you're buying $1 million property at 20% down, all right, you're at $200,000 down. Now you have $25,000 in closing costs, $75,000 in design. Okay, now we're at $300,000 cash. What if I can get you that same property? Instead of negotiating it down $50,000, get $50,000 in closing costs and seller credits paid. So now you're only out of pocket 250 or 225 maybe. Now your cash on cash return goes up. Your gross yield may be a little bit less, but what's important to you? And I think it's important to analyze both aspects of it. And the biggest thing I ask every investor is, what are your goals, right? I may have somebody that's paying cash and they don't care about seller credits because they're paying cash for it. And some people are only financing 90%, 10% down. Some are at 20%. So it really comes down to each individual on what's important to you, and then working with an agent that can structure the deal that's going to make your goals be hit.
Yeah, I like that. It just also shows how many creative ways you could structure a deal. And that's why, for me personally, I go to an agent when I want to help on that, or I'm talking to my lender for different ways that we can structure it to keep more cash in your pocket. One thing I know that comes up a lot is you could finance a house. How about financing the furniture and the setup costs and the amenities? How do you think about setting it up after the purchase?
It really comes down to, understanding the market and what you can do to a property to not be spend too much, right? There's designers out there that are putting in 300K designs. And in some of those situations, they're remodeling houses and adding square footage and bathrooms and all this kind of stuff. Well, all that is going to increase the value of your home, right? So if you're spending that kind of money and you're increasing the value of your home, and the most recent example I can give you is, my team leader, Tyler Kuhn, who bought a property at 800K, put in a $300,000 rehab on this property. So he was 1.1 million all in. But after his rehab, it actually appraised at 1.9. So he ended up picking like seven or $800,000 of equity on this property. So after he did a cash out refi, he ended up being in the property at $0, $300,000 in gross revenue, cash flowing 100 grand a year. His cash on cash return is 1,000%. Right. So every
Yeah.
single deal is very different on how you structure it. A lot of people want that turnkey. Right. And if you're looking for that turnkey that you don't have to go in and do any value add, you're going to pay top dollar. And now your cash on cash return is going to be a little bit lower. And there's nothing wrong with that. It's just
Mhm.
understanding what your cash is that you have and what your goals are.
Yeah, that's a very good point at the end. What are you personally looking at from your investment philosophy? Are you looking for value add deals? Are you also looking for a more turnkey solution where different techniques to maximize revenue without having to do a big value add, or what's your personal investment philosophy?
Our first three investments were definitely a little bit more turnkey because we didn't have as much cash on hand. So
Mhm.
we didn't have the cash to go in and do rehabs and stuff like that. But now we're sitting on a little bit more cash because we've been successful in the space. Now we're kind of starting to look at, okay, can we find some of those value add properties? Can we find some of those properties that we could, really make a big impact? So I think it everybody is at their own part of their journey. I love the saying that comparison is a thief of joy because you don't want to try to compare yourself to anybody else in the space because we're all on a different path. And you just have to look at your finances and what your goals are and what your 3-year plan is, what your 5-year plan is, and really understand where you want to be.
Yeah. Yeah. Great. And then in terms of, let's say, first time home buyer, first time investor, first time getting into the short term rental space, what are some mistakes you've seen that people should look out for or avoid at all costs?
Yeah, I think there's a few big ones. Number one is trusting your data, and I'm going to say trusting your realtor, right? And the reason why I say trust your realtor because there's a lot of realtors out there that don't understand the business, and they're in it for the sale. They're not in it for the long haul to be able to actually help you. So don't trust somebody else's opinion or thoughts or pro formas. Do your own research, right? It's really, really important. Obviously, if you partner with a savvy STR agent, we're going to do our best to help you, but you still need to do your own due diligence, right? You still
Mhm.
need to make sure that you understand, exactly what the ups and downs and the pros and cons are. A lot of people like to use free data, right? You can go into, these data platforms and type in the address and it says, "Oh, your property is going to do X." That is
Yeah.
complete malarkey. There's nothing accurate on any of that because all it's doing is taking the averages. It's not looking at your amenities, your views, your proximity to whatever it is, whether it be the beach or the strip or whatever it may be. It's not taking any of that into account. It's just giving you an average. So you really need to make a deep dive. And people are like, well, it's $200 or $500 in data. You're spending tens, if not hundreds of thousands of dollars on this investment. Why wouldn't you spend a few $100s on a data tool to make sure you have the right stuff?
Right. And I don't know if you said this earlier, but what is your favorite data source?
I go back and forth between STRIQ and AirDNA.
Mm.
For the longest time, I switched to STRIQ because they had a bunch of updates that AirDNA didn't have. Then AirDNA switched and got a bunch of updates, and I can look at top properties a lot easier and I can find data there. So I really use both data platforms. And, we use Data Rabu and we use STR Insights and we do these other ones too, but those are probably the two that I use the most. There is a third one that I like to use, and that's PriceLabs, because if
Mhm.
you're an active investor and you have a PriceLabs subscription, you can find some really good data inside PriceLabs as well.
Yeah, yeah, totally agree. We use AirDNA and PriceLabs ourselves. And then financing, like obviously you're not a lender, but you've seen enough deals as an agent and as a buyer. Is there a specific type of financing you're typically seeing or that you use personally?
Yeah, I mean, the very common is DSCR loan. And what a DSCR loan is a debt service coverage ratio loan. So what they're doing is they're not looking at your DTI, they're not pulling your tax returns. Do you have a good credit score? Do you have enough money for the down payment? And will the house pay for itself? Now, in a
Mhm.
DSCR, you're typically going to be 20% down. Sometimes the rates are going to be just a tad higher. So we also do a lot with, second home loans, conventional investment property loans, and you can get 10% down or even 20% down. And if you're a high income earner and you have a or low DTI and you have plenty of room, that's a great way to get into your first or second investment. Eventually, unless you're, Elon Musk, you're going to run out of DTI and you're going to have to go the DSCR route potentially. But in the beginning, it's not a bad way to go. Our very first property was a conventional investment loan at 20% down. And then our next two were DSCR loans. And we're looking to do one of each actually by the end of this year.
Okay, there we go. Yeah, we just did a DSCR loan ourselves, 20% down, which we see a lot for this type of investment. And then, yeah, you said you recently purchased a property yourself and you're looking at the bonus depreciation play. So, could you share a little bit more about the property that you just purchased and how you're going to go about making sure not only is it going to be a great for taxes, but it's also going to be a great investment holistically?
Yeah, so we actually closed on it in December 25. So we actually did our 24. So we actually did our cost seg and everything. So our purchase price was 785, and we did get about 40K in seller credits when it's all said and done. After land value was taken out, our bonus depreciation number, was $628,000. From there, that we get, roughly 25% of that. So it lowered our taxable income for the year by about 125 to $150,000. I don't remember the exact numbers, but somewhere in that ballpark. And so that ended up lowering our tax burden, what we actually owed, by over $35,000. So,
Yeah.
so when I look at the cash on cash return side, we ended up doing 144,000 with a 35K profit for the year. Plus I had, $35,000 in tax savings. So I had a 70,000 to the positive for the year, and we only put $156,000 into it. My cash on cash return was around 44%. And that was before the 4% appreciation, the $6,000 of debt pay down, the long-term depreciation, that's going to be part of it. So,
Yep.
when it's all said and done, we were actually probably closer to about, I think I just did the math. It was like 69% cash on cash return, in benefits in the first year. And you can't do that in the stock market. So,
Nope. That's for sure. Yep, that's incredible numbers. Congrats on that purchase. And I don't know if you're like me, but I plan to do it every single year and continue to get that inflated return. For a client that comes to you and is saying, "Hey Joe, I'm looking to qualify for these tax benefits. That's why I'm hoping to purchase these short-term rentals." Like, what do you say to them? How do you typically guide them around that subject? And yeah, obviously we're not CPAs, we're not
yep.
tax attorneys and
That's
all
the
that.
first thing that I tell them is
Yeah.
I'm not a CPA. Here's what you can do.
Yep.
Here are the benefits that you potentially could get, but you
Mhm.
need to go talk to your CPA. I just had one today. He's under contract for a condo. He wants to take advantage of the cost seg, but the house or the condo is fully booked. We close in the end of May and it's fully booked with the property manager for June and July. So can he still use that property manager for 2 months, take it over in August, get enough, material participation between August and December to offset what the property manager did to still be able to get the cost segregation? And I can't answer that. That's what his CPA has to answer that, right? That's a conversation for him and that's going to decide if they decide to do the cost seg or not,
Mhm.
or cancel all those bookings and start self-managing it from day one. So, you have to, there's a lot of different little things that you have to do. The one thing I will air and tell everyone is when you do a cost segregation, you are increasing the likelihood of you getting an audit by enormous percent, right? So whatever you do it right. Don't
Mm.
don't think you can pencil it. Don't think I can just, you know, fudge this here and fudge it there. That
Yep.
you do increase your chance and likelihood of getting a IRS audit. And my CPA is very, very adamant about the documentation. Before they would even do my cost segregation, I had to make sure I had all of my ducks in a row and had all the documentation in place, because he's going to be the one that defends my audit if that day comes. And he defended, I think, 5 or 6 this past year.
Yep.
And that's important to have a CPA that truly understands it to a T on everything that you need to do.
Yeah. Yeah. Absolutely. And that's part of this program as well, is connecting with some CPAs that really understand this business, because there are so many nuances to qualifying for material participation and the actual benefits. So, yeah, tell me about your process. If someone wants to reach out and is interested in one of your markets or working with, one of the savvy agents, what's your process from the first call to handing over the keys and maybe even beyond that?
Yeah, I mean, we're pretty much hands on from the get go. If you don't know what market you want to do, you're going to set up a market match with our savvy team, which is in Asheville. We have multiple people that all they do is do market match, talk to you about your goals, your budget, what you have in cash, and get you aligned on, do you want to be in a mountain market or a suburban market or a beach market? And then from there, they'll usually get you hooked up with up to 3 of us, so you can
Mhm.
talk to 3 different people in 3 different markets to see where you like the best, right? And when we get on the phone call, obviously our job is to sell you on our market, to tell you why it's a great place to invest. But I'm going to tell you, invest where you want to go, right? If you're going to be successful in this business, you're going to be more successful if you invest in a place that you want to be. So once we get on the phone with you, we're going to obviously find out what your goals are. I use a VIP list personally. So I scour the MLS on and off market daily and add it to my VIP list of the clients that I'm working with exclusively, get access to my VIP list and the properties that I think could be good short-term rentals. And then contract to close, like we're every step of the way. We have a vendor list for you for everything from cleaner to handyman to HVAC to designers, landscapers, all that stuff. So we're going to help you in the process of finding every single person to help you along the way. And
Mm. Yeah, absolutely. And as a buyer, correct me if I'm wrong, there's not an agent fee associated with that. That's typically the seller paying that.
The seller is still paying buyer agent commission. Typically, the listing agent or the seller is still paying the buyer agent commission at this point.
Right. Are there any other costs to working with Savvy?
No.
Nope. You mentioned you just had a huge year of you know, STR clients coming to you. Could you give me the breakdown of the STR clients that came to you for, the tax benefits, and out of those, how did they handle the management portion of that?
Yeah. So, I mean, I sold 38 properties last year, over $30 million worth of real estate when it was all said and done. And the majority of our clients come to us that want to self manage because they want the cash flow, but there's some that just really want the tax benefits. And so what they'll do is they'll actually come in and purchase the property and self manage it for, 2 months, 3 months, actually, 18 million of my deals last year were closed in December. They got their tax benefits, got their material participation, and then January 1st, they hired a manager because you only have to show that material participation in the year that you take the cost seg and the year that you buy it. After that, you can wash your hands clean, hire a PM, and sit back and just let it do its thing.
Right. And you mentioned majority, like 90% or something, decided to continue to self manage.
Yeah, many of ours decide to self-manage because if you're looking for true cash flow, right? Like what are your goals? Right? If you want tax benefits and a little bit of cash and long-term appreciation, hire a property manager and or a co-host. And typically your smaller boutique co-hosts, people like what you guys do are going to give you much better returns. But if you want that 35K profit, then self-managing is going to be the way it goes. Now, that being said, self-managing isn't sunshine and rainbows, right? So you got to think at 9 p.m. on Friday when you're out or you're at dinner with your wife and you get that phone call and your guest shows up and the HVAC isn't working, who's handling that?
Right. And there is always the option to hire a property manager after you qualify for the material participation, but it just generally you manage, you said 10 properties.
Yeah, we were up to 14. We pumpkin planned down to 10 this year. And,
And
I probably spend, on all 10 properties because I did hire a revenue manager. I'm still probably spending 3 to 4 hours a week managing 10 properties when it's all
yeah,
said and done.
yep, 3 to 4 hours a week. Yeah. And that's 10 properties for the student managing one. Do you think that would be closer to maybe 1 hour a week?
Yep, hour and a half a week. 10, when I only had one property, I'd spend 10 minutes in the morning doing a little listing optimization, tweaking the pricing, and then kind of forget it the rest of the day. Maybe get the occasional guest message, asking a question.
Mhm.
And honestly, with AI and things like HostBuddy and Claude and things like that, I think our time actually talking to guests is getting ready to go down significantly than what it used to be.
Right. Well, this has been fantastic. I absolutely will throw your contact information at the bottom of this video. If anyone wants to reach out to Joe and learn more about his market, his own investments philosophy, he's also a great host and operator. So just a wealth of knowledge in this space. Joe, appreciate you being here. Any last words or last advice that you would give to the STR buyer that is just getting going, ready to find their market, find their property, operate it, get the tax benefits, and now have a flourishing short-term rental?
Yeah, I'm going to leave you with this. The day you go under contract, you should start everything, right? Your designer should be started. And you should be talking to designers up front before you even go under contract and, finding out, what type of property and understand what type of design that's going to work in the space. But what I see a big mistake with a lot is we get all the way to closing day. And then the week after closing, they're like, okay, I'm going to call a designer now. Well, these designers are 3 to 6 weeks out, right? They're not going to drop what they're doing. And the longer you go from closing day to live is all the carrying costs that you're going to carry, right? So, people like Kim Fitzpatrick works with designers to where from closing day to launch day, you could be 7 days, right? When my wife and I purchase each one of the properties that we've purchased and we've helped co-host some properties from the day we take over to live on Airbnb and taking bookings, we are less than 7 days. And I've seen people
Mm,
take a month, 3 months, 6 months, and all of that needs to be factored into your pro forma if you think it's going to take there. Now, obviously, if you're doing a big rehab project, it's not going to be a 7 day, right? But if you're buying a
right.
property that just needs new design, new furnishings, wallpaper murals, and some outdoor amenities, man, you got to get that going right away and start making money because the longer it takes for you to have that setup done, it's the more carrying costs and it's going to make your pro forma go upside down that didn't actually work out from the beginning.
Yeah. Wow. Great advice. Great place to end off. And thank you again, Joe, for your time. And if anyone wants to reach out again, his information will be below, and we'll see you on the next video.